Hey everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, September 5th, 2025. Can't believe it's September already. Hope you guys had a great summer and a great Labor Day weekend. To wrap it up, we are back to update you again on the markets and the economy. With the Labor Day holiday, it was a shortened trading week this week, only a 4-day trading week, but no shortage of action here for us to discuss. We had some important data with the jobs market, which you can see here on the screen, as well as a couple other things that we'll go through here together. So let's start with the big one. Obviously, it was a pretty quiet week for economic data, but we did get the monthly jobs report showing us hiring progress and labor progress for the month of August. This is coming on the back of the previous report for July, which was revised downward. We talked about that at the time when it happened, starting to show a little sign of slowing in the labor market, which is normal, as economic recoveries get longer and longer. But nonetheless, there is concern in the market, as has been talked about widely for months, that Jerome Powell and the Fed have overstayed their welcome at higher interest rate levels, and they are starting to put pressure on the job market as a result of it. So for those of you that have been with us here for a while, we have been through this cycle with the Fed and the labor markets and interest rates and how they all come together many times before. But for those of you that may be newer to this, I'll basically break it down for you like this. The labor markets, naturally, we're always rooting for a good labor market, right? Because a good labor market means a stronger economy. And we want to see people at work, being able to get jobs, being able to change jobs if that's something they so desire. But when you bring the Federal Reserve into the picture, right, and we're talking about potential interest rate cuts, okay, it creates a scenario where for those rooting for interest rate cuts, right, they don't want to see the labor market too strong because then that would suggest to the Fed that they don't need to cut interest rates. But at the same token, you don't want to see the labor markets too weak, right, because that's indicative perhaps of a recession. And so you're starting to find yourself in this predicament where you're looking for labor numbers that still show growth, right? Positive numbers, but they're not too strong that keeps the Fed from actually cutting interest rates. And so that's where we find ourselves now. And the labor numbers have been strong for quite some time. Remember, we had a massive downward move in the labor market in COVID, right, in 2020, and we've spent a number of years repairing the labor markets since then. So not a great number in July, still showed growth, but wasn't a great number. So fast forward to August, economists were looking, for 75,000 new jobs added. We felt that estimate was far too high. Given the revisions from last month, we were looking for something closer to 25,000, and payrolls came in at 22,000 in August. So again, expectation at 75, the number comes in at 22. Naturally, two things happened. Well, first thing that happened was we basically have solidified now with full certainty that the Fed is cutting interest rates in a couple weeks, right, at the September meeting. We know it's coming. The question now, given that the weakness in the labor market has shown up a little bit, is will the Fed give us essentially two interest rate cuts, right? So think about it as 0.25% is kind of widely considered as one cut. If they go 0.5%, that's two interest rate cuts at once. So whether or not that happens remains to be seen, but this is the narrative that's starting to float. At the same time, as what we call the recessionistas are all back, right, screaming from the rooftops that we're heading into a recession. Now, that is not our view. Our view is that AI is very important. AI is driving a lot of productivity growth and it's driving a lot of efficiency and profits, but at the same time, it's starting to dent the labor market a little bit. So we see a scenario over the next couple months, quarters, and years where you could still continue to see good growth in the stock market and companies in the stock market, but you're going to continue to see AI take a little bit of a bite out of the labor markets as businesses realize that they can do some things more efficiently, perhaps with less labor. So we're not rooting for a labor recession, but I think this could start to be a little bit more the norm where we have job growth, but it's not tremendous. So that was the news we got. And when you look at the trend, right, naturally coming, this goes back to 2022, but we had a lot of job losses in COVID, and then we had huge job gains as we put people back to work. And so naturally, the jobs created per month is trending lower, right? Which is normal after any recovery. We're not going to keep adding 380,000 jobs per month, right? The labor markets are pretty full at this point, where our unemployment rate's around 4.2%. So, and as you know, the unemployment rate never gets to zero, right? And so 4.2 is pretty good, but you can see the monthly average jobs added has been heading downward for the last couple of years. And so right now we're running about 75,000 for, the year of 2025. So that's largely where the economists get their expectation for 75,000 jobs. We also have to consider some seasonal factors here, right? Summer, August tends to be a little bit of a slower hiring month. Some seasonal summer jobs are going away. And so again, when you fast forward to Q4, you have a lot of seasonal hiring for the holiday time ramp up. So I think, there'll be some ebbs and flows here, but this will balance out. Looking at the Fed Watch, which is, I haven't really shared this, I don't know that I've ever shared this tool with you guys, but what we're looking at here is the odds of an interest rate cut at the upcoming meeting. So we can see the meeting is on September 25th, 25, and basically there is now a 100% chance, according to the market, that the Fed's going to cut rates. 91.8% chance that they cut by 0.25%, and about an 8.2% chance that they cut by 0.5%. So just go back 10 days ago, the odds here were dramatically different. There was a 0% chance of a 0.5% cut and only a 60% chance of a cut at all. So we think this has set the stage here for successive rate cuts into the end of the year. So markets tend to take a little bit of time to adjust to this, right? Yay, we want rate cuts, but wait a minute, are we getting a recession? That's not our view. We don't think recession's coming. I think economic growth will continue to be strong, but this is naturally what the market is grappling with. So let's take a look at the markets here together. All in all, markets continue to act very well. We came in on Tuesday to a pretty steep sell-off to start the shortened trading week, and then markets showed a lot of strength and buoyed right back up. Buyers stepped in, and you can continue to see that as a theme, folks, right? We get a sell-off, if you will. You get a sell-off, and then buyers bring it back, and then you get a sell-off, and buyers bring it back, and then you get a sell-off, and buyers bring it back, right? We're taking the stairs higher. That's a good thing. This also speaks to the fact that there is a lot of investors sidelined or underinvested, and they're using every little dip and opportunity to put money to work because they don't want to miss what could potentially be coming next. So markets continue to act beautifully here at all-time highs. You like to see neat and tidy consolidations at or near the all-time highs, and that is a sign of a continuation of the uptrend. So you can see where we're going, where we believe we're going, and where we came from. We've been very accurate in laying out the path forward for the market, and we continue to believe that we will be accurate into the year end. I think that we're getting to the point here where you're going to soon see what we would call breakaway momentum, right? Where we're going to kind of trade in this stair stepping for a much stronger move higher. And as momentum starts to build, the speed of the ascent will continue to increase. We may end up being conservative here in our year-end target, and I think that'll be quite all right if we exceed the target to the upside. Also, just wanted to share, we just spoke about the Fed and interest rates. Well, here is a visual representation of interest rates. Let me just clean this up a little bit here so we can see what's going on. And folks, rates are headed lower. You can see it here in the chart. We have gotten really below a critical level here, which the market and the rates have spent a lot of time in this area, and this is a very clear breakdown of the trend. So as we study a lot of charts together, right, very few and far between do we root for a chart to go down and to the right, but interest rates is one of them, and this is the 10-year Treasury bond market basically signaling what we all know is that the Fed's cutting rates next week. So as rates come down, the cost of capital comes down, capital expenditure and investment for businesses becomes cheaper, they're able to get access to more money, and this tends to be a tailwind to the stock market. So remember, we've rooted for most charts to go up and to the right, but this one here we want to see down and to the right, and we believe that that is exactly what we're getting. So again, markets sitting right up against those all-time highs, actually, basically going out at an all-time high. And so given that backdrop, let's check on our institutional investors. They must be feeling more optimistic, right? And again, they are not, right? So if you look at the institutional surveys, these folks just keep getting more bearish, and it's just a remarkable thing to see. Markets keep moving up, and these folks keep getting more bearish. I really don't know what these folks are so scared of, but it's a beautiful thing when you're at all-time highs in the stock market and 44% of institutional participants in the market do not believe the market's going any higher. That means we have a very balanced market right now between people that think it's going higher and people that's not. I still think we are in the minority as folks that believe that this market is not just going higher, but going meaningfully higher. And that's been the case all the way through, folks, right? We were the minority back in April talking about new all-time highs this year when it seemed absolutely crazy. And we still continue to be in the minority here as we expect the markets to start to run away from the pack. So we'll keep checking back on this week in and week out. But these folks are still very bearish, and that's a beautiful thing for us to see. Let's look at next week as we get closer to the Fed meeting. Now, the Fed meeting is not next week, it's 2 weeks out, but we're going to continue to get economic data in the lead up to that, and we're going to do the inflationary data again next week. I feel like almost every time I'm on here talking with you guys, we're talking about inflation, CPI, PPI next week. Here we are again, the monthly readouts. We're going to get our producer price index on Wednesday, and we're going to get the consumer price index on Thursday. So they switched it on us next week. Usually CPI is first, then PPI is second. We're going to get it in reverse. Doesn't really matter. It's going to tell the same story, which we believe is that inflation is pretty tame, and it sets the table for the Fed to cut on Wednesday, the 17th. The Fed is also in the news recently, as we had one Federal Reserve governor who resigned really without reason or without providing a reason. And there's a second Fed governor right now that is being alleged to have committed mortgage fraud by declaring 3 residences as her primary residence to achieve lower interest rates. So a lot of that is noise. I don't think that has any impact on what's going to happen at the meeting on the 17th. I think the Fed knows where interest rates need to go. They've likely overstayed their welcome, but they still have time here to cut rates and to get back on the right side of things. So all in all, we're going to the Fed meeting on the 17th with a 100% probability that the Fed will cut rates, right? So the Fed does not like to surprise markets in a way like in this example where we have 100% probability of an interest rate reduction. They're not going to come in and not cut rates, right? They don't want to catch the market that far off guard. It just is a conversation right now between do they cut by 0.25% or 0.5%, and something tells me that our inflationary data next week in the CPI and the PPI will go a long way to answering that question as far as what the Fed is going to do. But I think the market is starting to realize it's not just going to be rate cuts in September. We're probably looking at cuts in September, October, November, and December based upon the way that things are shaping up. So all in all, markets are acting well. We go out another week right at those all-time highs. We got through the earnings season, which was very strong, much stronger than expected. And now we will move into the latter part of the month here. And again, remember, August, seasonally a weak month. We notched gains in August. September, seasonally a weak month. We believe that this year is going to be much different. I see way too many people clinging to negative September seasonality as a reason why the market has to go down. Remember, folks, the market doesn't have to do anything. Just because you want it to do something doesn't mean it will. It's our job to evaluate with clear eyes and open ears what the market is telling us. And right now I see a market, I think, that's prepared to put in a very good September, well above expectations, and leave a lot of people in the dust. So we will be back to update you every step of the way. As always, if you have any questions, reach out to us. We're always here to talk to you about anything that matters with your money. We hope you have a great day, a great weekend. Football is back this weekend, so hope you enjoy it, and we'll be back next week to update you. Have a great weekend.